All right, so Heritage Global just dropped their Q3 earnings, and wow, the market's reaction was not pretty. Here on Talk Tickers, we're going to break down exactly what went wrong, what management's game plan is now, and what you should be looking out for. So let's get right into it.
So let's start with the market's immediate verdict. The stock just cratered, dropping over 9% right after they released the numbers. And this wasn't just a little dip, Trading volume was massive, like 4 or 5 times what it usually is. That tells you investors weren't just spooked, they were actively heading for the exits.
So what caused all this drama? Well, it was a pretty significant miss across the board. I mean, look at this. Earnings per share came in at just 2 cents. That's half of what Wall Street was expecting. A 50% miss. And revenue? That also came up short by about 13%. When you miss on both the top and bottom line like this, yeah, the market is almost always going to punish you for it.
Okay, so let's look behind the numbers, because the figures themselves are one thing, but the why is the real story here. Let's dig into what management had to say.
The CEO, Ross Dove, basically blamed it on what he called a wait-and-see economy. His point was that the big clients, the ones that really move the needle, were just sitting on their hands. They were delaying major deals, and without those huge blockbuster transactions, it's really tough to have a great quarter.
So what do? Well, they adapted. Instead of landing a few whales, they went out and caught a ton of smaller fish. You can see how that changed their business mix, right? The steady services revenue went down a bit, but the one-off asset sales shot way up. The problem is, while this helped plug the revenue hole, this kind of strategy can really squeeze your profits.
And here's the proof of that squeeze. Chasing all those smaller deals really hit the bottom line hard. Even though their total revenue was actually up compared to last year, look at the profitability metrics. Operating income, net income, EBITDA, all down by double digits. And that net income drop, a whopping 46%. That's what happens when you prioritize just getting deals done over getting the right, profitable deals done.
All right, so after a quarter like that, management obviously had to come out with a new game plan. They're trying to shift the conversation away from these bumpy, cyclical results and get investors focused on a bigger, more strategic, long-term vision.
And the heart of this new strategy really comes down to how they're spending their money. So they have this big share buyback program authorized, but they put it on hold this quarter. Why? Because all that cash is now being aimed at one thing: mergers and acquisitions. They made it super clear that they're in advanced negotiations for some deals. So the message is, we're not buying back our own stock, we're buying other companies to fuel our growth.
Now, it's not just about M&A. They've got other things cooking too. There's this new facility in San Diego that's supposed to bring in higher margin business, which is great, and they're still optimistic that those big deals they were waiting on will eventually come through. And the key to all of this, they have a really solid balance sheet with almost $20 million in cash. That gives them the firepower to actually make these moves happen.
So this all sets up a really interesting showdown, right? It's the market versus management. You've got management painting this very optimistic, long-term picture, and then you've got the market, which is just staring at the ugly results from this quarter.
And you can see the market skepticism written all over the stock chart. Over the past year, the stock is down more than 23%. Meanwhile, the overall market is up over 12%. I mean, that's a huge divergence, and it really shows you just how much doubt is baked into the stock price right now.
But, and this is a huge but, here's where the story gets really wild. Despite the terrible quarter and the awful stock performance, every single analyst that covers this company still has a buy rating on it. And get this, their average price target is around $350. That's suggesting there's more than 150% upside from where the stock is today. Crazy, right?
And that just leaves us with the million-dollar question, doesn't it? Who's right? Is it the market, which is clearly skeptical, or is it the super optimistic analysts? That's the puzzle every investor has to solve right now.
Okay, so with all that said, let's get to our take. What do we think is going to happen next? Here's what we're looking for in the next quarter.
Look, for Q4, we're not expecting any fireworks. We think the numbers will probably come in right around where the street is already expecting, so pretty muted. And because of that, we see the stock just staying stuck in this tight range, probably between $1.20 and $1.50. The market is basically telling management, we're done listening to promises. You need to show us the goods. It's a total show-me story right now.
So what would showing the goods actually look like?
Well, for us, it's a 3-step checklist for the stock to get its mojo back. First, they've got to announce and close one of those acquisitions they keep talking about, and it has to actually help the bottom line right away. Second, that new facility needs to start pumping out better margins. We need to see it in the numbers. And third, they've got to land one of those big, whale-sized deals again. Simple as that.
So when you add it all up, we're slapping a market perform rating on this one. Look, the long-term story with the M&A plan, it's actually pretty compelling. If they pull it off, there's a ton of upside here. But, and it's a big but, the risk in the short term is just too high, and the economy isn't helping. For us, it just makes sense to stay on the sidelines and wait for them to prove they can execute on one of those catalysts before we get more excited. And just as a reminder, of course, this analysis is for informational purposes only. It is definitely not financial advice.